Good afternoon, everybody, and thank you for showing up today to our hangout on the VetNet Entrepreneur Track. Today's class is going to be hosted by Mr. Ed Jenkins, who is a tax director at a company called CBiz. And we have him over the phone today doing our hangout, and I'm just going to turn this over to him. So, Mr. Jenkins, thank you for being here today.
Oh, well, thank you very much, Jim. Well, hello and welcome to everybody. I'm really proud to participate in Syracuse's Institute for Veterans and Military Families. I have a passion for the topic this evening, choice of entity, as well as a passion for folks that are coming home from wars and thinking about starting businesses. So I think it's terrific what Syracuse is doing, and I'm very proud to be associated with the program this evening. I think we have some folks online. Can you identify yourself just maybe by first name? And
Yeah, certainly. My name's John. I'm a veteran of the United States Marine Corps, and I'm here trying to just get a feel for entrepreneurship. I'd like to be a motivational speaker. I'm working, networking with principals and people in schools to start out with kind of troubled teens or high schools and work my way from there.
I'm a former blue and gold officer at the Naval Academy, so I'm a little bit familiar. While I didn't serve in the military, I have been involved, and I have a son who wants to go into the Marines when, and go to the Naval Academy. So
Very nice.
it'll be interesting, and I have a feel for you there.
Great.
Let's chat a little bit about choice of entity this evening. Since a lot of veterans are thinking about starting businesses, one of the first things you have to figure out is, well, what form of business is it going to take? So I have some slides that I've made available. Form of business is it going to take? And I guess if Jim can point to maybe the first slide, which just is an introductory slide about choice of entity. And the first thing there, of course, is a disclaimer that we're presenting the information just for informational purposes. And if you do start a business on your own, you really should have a team of advisors helping you. And your tax advisor is one of those that should be providing you with guidance that's specific to your own circumstances. So our discussion this evening is kind of general in terms of choice of entity. If you go to the next slide, which talks about the learning objectives for tonight. So there are really two big objectives for this evening. And the first is to help you understand what the four main drivers are behind which kind of entity your business is best placed in. And the second are to give you an overview of the pros and cons of each of the types of entity. And the list of entities is a little bit more detailed in practice, but for our purposes, really we talk about a sole proprietorship, general partnership, limited partnership, limited liability partnership. We have what we refer to as a regular or subchapter C corporation, and subchapter C or in subchapter S just refer to subchapters in Title 26 of the United States Code, what we lovingly refer to as the Internal Revenue Code. So a regular or subchapter C corporation is your normal corp, like IBM. Subchapter S corporation is a company that's made an election to be a corporation, but to be treated kind of like a partnership as a pass-through entity for tax purposes. And the last entity on our list to talk about is what's called a limited liability company. So if you could go to the next slide, we sort of need to preface the conversation about choice of entity really starting by a sensitivity to the tax rates that you need to think about or have in the back of your mind. And as that may suggest to you, taxes is one of those four drivers we'll talk about. But just to give you an idea of the tax rates that you could experience, really at the low end, you'll see the chart being somewhat Pennsylvania-centric. But you'll see at the low end, the lowest federal bracket is the 10% bracket. And until you add all of the different tax rates that may apply, even in the lowest bracket, you come up to a maximum or a total tax rate of around 28 cents on the dollar, or 28%. Now you'll notice that I'm including in that list of taxes, in addition to the federal tax and Pennsylvania tax, New York, of course, has its own state and local tax. You'll also notice that there are both pieces of Social Security here. There is, of course, the FICA part that you're used to have come out of your paycheck, but your employer also matches the other half of the FICA insurance. And then you'll see the Medicare insurance, what we call OASDI, which is what we refer to as Medicare. You'll see that tax rate for the individual as well as the employer match also. So when you add all of those different taxes up, in the low range, you're talking about 28%. For those in the new higher bracket for 2013, your federal income tax could be as high as 39.6%. And then you've got the Pennsylvania rate at 3.07. I'm not sure what the New York rate is. You may also have local taxes, earned income taxes in Pennsylvania, and I'm sure you do in New York also. They can be in the 1 to 2% range depending upon the municipality. And of course, you've got the FICA at 6.2% for your higher earners. And you'll notice here that there's a new sort of tax here on the Medicare element for the individual higher earner. You'll notice that it's 2.35% instead of 1.45%. That's part of the new health care law. That's an additional tax for those who earn over $200,000 as a single individual or $250,000 joint. We're actually just looking at and evaluating the IRS regulations for how they're going to work that tax. So it's a fairly new tax, and they don't have all the kinks quite worked out of it yet. You'll also see on the tail end for an upper income individual an additional FICA tax on what's called NII, or net investment income. That's another tax that came out of the healthcare law that applies to individuals earning more than $200,000 or households over $250,000. And that's an additional 3.8% tax rate on the upper income. So if you add all of those up, and not all of those taxes apply to every level of income, but you could be taxed at a very high percentage. So those are the individual tax rates to consider. I mentioned the individual tax rate just to sort of set you up with an expectation, because many small businesses are or reside in what's called a pass-through business entity, and so it's the individual tax rate that you have to consider in selecting the type of entity. If you are in a regular corporation, then those tax rates can vary from 15% to around 35% for federal purposes, and the state percentages will vary for corporate earnings. They can be as high as Pennsylvania's 9.99%. So the corporate rates of return typically will run on average around 40% between federal and state corporate income tax. But because most small businesses really use pass-through entities, it's these individual tax rates that are probably the most important. So what are the drivers? And if you could go to the next slide, I'd like to chat just a little bit about what really are the main drivers behind which business entity you should choose for your startup business. John, do you have any questions about the tax rates or why those are important before I talk about the drivers at all?
No. So far you've been really descriptive, and I understand what you're saying.
Okay. We have four main drivers behind the selection of business entity. The first is really limits to liability. The second is taxation. The third is how easy is it to get in and out of the business entity. And the last one is, how are the owners of the entity compensated for their investment, or what's their reward? So 4 big drivers, and we'll talk about each of those drivers in the context of each type of entity. So if we could go to the next slide, let's talk about our first pass-through entity. And when I refer to a pass-through entity, I'm generally meaning that the results of the performance of the business are taxed at the individual level. So you may have an entity there for a variety of purposes, but the taxation for the business profits happen at the individual level, and that's why we call them pass-through entities. So our very first type of entity to talk about is a sole proprietorship. I think in translating these to the Syracuse University slides, we lost my happy face and my sad faces. But the sole proprietorship, one of the biggest concerns that we have there is unlimited personal liability for business claims. And that means there's no limit as to liabilities for the business. So if something will go wrong in the business, somebody might get hurt perhaps by a product or a service that you offer, then that person can sue the business, and the sole proprietorship is the person. So all of your individual assets are available to satisfy claims of the business. And that's a fairly scary thing as a general rule. But when you think about it, for instance, I'm a CPA. If I wanted to be a sole proprietor, you have to say, well, you know, what could go wrong? You know, maybe a client might get a paper cut at my conference table. Might be the worst thing that might happen. So, you know, if you're in the construction business and you might drop a 2x4 on somebody's head, that's a pretty significant liability. But in a CPA business, you know, there might not be anything all that disastrous that could happen. And probably the biggest source of personal liability in that kind of business ends up being your car and what you do in terms of your personal transportation for business purposes. So really the first driver for a sole proprietorship is this idea of unlimited personal liability, and you really need to understand what kind of risks your business is going to be exposed to make a good choice there. The second driver for the sole proprietorship is the tax rate. First of all, as a pass-through, your business activities all get reported on Schedule C of your Form 1040. That's your individual income tax form. And that form reports the profit from your business. If your business is at home, you may even be able to take advantage of the home office deduction for your business. And that's a wonderful tax benefit because you can actually, if you choose to not pay rent to somebody and have your business and meet clients or customers or build out a location at your home, then that's a pretty potent deduction because you can deduct a portion of your interest, your taxes, and all of the expenses that you incur for your office there at home. So there are some special things about Schedule C and sole proprietors from a tax perspective that are attractive. Additionally, there are opportunities to hire children in your business that are a fairly attractive tax planning idea. But in general, sole proprietorships have a fairly high tax rate for an active trader business. And when you look back to your sort of schedule of tax rates, it can be anywhere from 28 to 64% in terms of the effective rate because the sole proprietor pays all of the income taxes, but they pay both the employer and the employee share of FICA and Medicare taxes. So you're not paying just half of the FICA and Medicare as you would as an employee, paying both pieces. So it's taxed at a fairly high tax rate in terms of the active trader business income. Now the sole proprietorship, when we look at the third driver, the formation and liquidation, a sole proprietorship is really easy to form. Pretty much you hang a shingle on your door and you're open for business. You know, you have to address your risks appropriately. if your business is in your home, you really need to check your homeowner's policy and your vehicle policy to make sure that your policies cover what you're doing in your business. One of the shockers that people can often get is they start a sole proprietorship and then they go and visit a customer on business, and God forbid, but they may have an accident. You may get a real shocker when their insurance company says, hey, I'm sorry, you told me you were out on a business trip for your sole proprietorship, and those things are excluded from your vehicle policy. So one important thing to consider is appropriate insurance coverage to manage the risk of any entity, and that's especially important for the sole proprietorship, and doubly important if that sole proprietorship is in your residence. And of course, having business at your residence, there are some security issues that you should probably also consider, but those are a little bit beyond the scope of our conversation this evening on choice of entity. So the sole proprietorship is really easy to form, and it's fairly easy to liquidate once you decide to take your sort of shingle off of your house and stop doing the business. Now, the last driver is how is the owner compensated for their efforts in their business. And in a sole proprietorship, owners receive draws, what we call an owner draw, and it's free of tax because you're already paying tax on all of the profit in the business on your Schedule C in Form 1040. So when you actually take the cash out of the business checking account, you've already paid the tax on it, and it's not a tax event in and of itself. So that's kind of the proprietorship. The big thing to remember is unlimited personal liability. Generally, that's not a great thing, but you know what? If you don't have big risks, you don't need to worry about it. Often, a sole proprietorship is taxed at a relatively high rate that includes both income and Social Security taxes. Easy to form, and owners are compensated by receiving draw. So that's our first entity that's a pass-through entity called a sole proprietorship. If we could go to the next slide, talk a little bit about the general partnership, the four drivers in selecting that as a business entity. First of all, the general partnership also has unlimited personal liability for business claims. But it's actually worse than that. Partnership, of course, is a business entity that's formed by more than one legal person. So you've got partners who own the partnership interest, and here's the part where it's worse. The partners, general partners, have joint and several liability. Now, an attorney is probably better suited to explain that, but in general terms, joint and several liability means each partner is 100% on the hook for all of the partnership claims. So if John and I decide to form a general partnership and own a business, and I'm the poor starving college professor and John is the well-heeled veteran, guess what? Somebody with a claim against the business isn't going to waste their time going after me. They're going to go after John's deep pockets for 100% of the claim, which they can do under the law. And John has to try and get the money out of me at some point later based upon the provisions of our agreement, for partnership. So it's actually worse. Any claim of the business can go against 100% any of the partners. Now, similar to a sole proprietorship, a general partnership in which you've got an active trade or business is subjected to a relatively high tax rate because you've got the income taxes to pay, but you also have both shares of the FICA and Medicare taxes. So for an active trader business, a partnership could be taxed fairly aggressively, both in income and Social Security. Now, a partnership is pretty easy to form. John and I can say, hey, let's go open up a pizza joint and hang our sign out and, get a couple of licenses from the local government for whatever we need to do from a restaurant safety perspective, and we're in business. Now, we really should have a partnership agreement, though, that spells out what John's going to do and what I'm going to do and how each of us will be compensated and what percentage of the business we own and what percentage we'll get if we decide to close the business. And that there's no requirement for a partnership agreement, but good common business sense says you should have one. So you can avoid the legal fees and not getting the partnership agreement drafted, but that is just generally not good business advice. You really should have a partnership agreement. Now, the last driver for a partnership is how do you get paid? And similar to a sole proprietorship, partners receive partner draws in a partnership. And those are free of tax because you're already paying tax.
All right, we apologize everybody for the technical difficulties. It seems that the Hangout kind of just closed down and kind of lost the connection here, but we still have Ed here, and he's just going to continue this as kind of a part two. So go ahead, Ed.
Well, good evening again. If you're on in the Hangout, could you identify yourself with just your first name? Well, thank you. We've been talking about choice of entity, and there are four drivers that we were talking about. The first driver, of course, being limits to liability. The second being how is the entity taxed. The third is the ease of formation and liquidation. And the last element or driver of choice of entity are really how is the owner compensated, or how do the people, how are you rewarded for your investment. So far, we've talked about the sole proprietorship and the general partnership, and then a variation of the general partnership, an entity we call the limited partnership. And the limited partnership we often use for real estate ventures. And in that case, the liability question is limited for the limited partners, but the one general partner that's generally required under state law has unlimited liability for business claims. The limited partnership, if it's an active trade or business, has a relatively high tax rate, but we often use this for passive investments like real estate, so the Social Security component of the taxes may not apply depending upon the activities of the partnership. You may just have income taxes apply, and if it's real estate, it will be reported on your Schedule E as a partnership. Generally, limited partnerships are fairly easy to form. Each state has its own rules for registration requirements and what documents are necessary for registration. Now, you should also have a partnership agreement that defines who's going to do what for the partnership and how, what percentage ownership of capital and profits and losses and that type of stuff. And last but not least, like a general partnership, limited partners receive draws, and those draws are generally free from tax since tax has already been paid on all the income in the partnership. If you could advance to the next slide, which is another pass-through entity. This is the limited liability partnership. You have to pay attention to the name because we just talked about a limited partnership. This entity is called a limited liability partnership. Now, most states have a variation of this entity. In Pennsylvania, the LLP, or limited liability partnership, is restricted to the profession. And generally, we're talking about accountants, attorneys, doctors, and engineers when we're talking about the profession. So if you're thinking of starting a professional organization, the LLP may be the right kind of entity for you. Let's talk about the drivers for the LLP. First of all, the general partner has unlimited personal liability for claims arising from professional liability. So I'm a certified public accountant, and if I were a partner in a limited liability partnership, I would be personally on the hook for any claims arising from the conduct of my profession. Now, the nice thing about the LLP is it's just my acts that I have to worry about, and depending upon state law and the state in which you're organized, there is some relief from the joint and several liability, particularly with respect to general liability claims. So if I'm an LLP and perhaps a client comes to visit our offices and has an accident on our door stoop, that has limited liability since that's a general liability claim, as distinguished from a professional liability claim, which is the conduct of my profession, perhaps giving tax advice or incorrectly completing a tax return without appropriate quality control procedures. So there's a distinction between the type of claim in an LLP. Now, an LLP has a relatively high tax rate because it's an active trade or business, so you'll incur both the income taxes we talked about as well as the social insurance taxes. Now, an LLP is kind of easy to form and liquidate, but depending upon your state, they'll have different requirements for registration and filing of documents. Again, you should have a partnership agreement that defines what the percentage ownership of capital is and how the profits and losses are split and who's going to do what activities for the partnership. And the last driver for the limited liability partnership is really compensation, and like all partnerships, partners receive draws that are free of tax. That's because tax has already been paid through Schedule E of your individual tax return for activities of the partnership. Now, we're going to switch up a little bit now and continue our discussion of pass-throughs, but we're going to switch now to corporations. And as we talk about pass-through entities, we have to first talk about the subchapter S, corporation. Now, corporation is a separate legal entity formed under state law. We have corporations, and the big plus for those are the limits to liability. So when you form a corporation, by definition, you're creating a separate legal person. So the only liability you personally have might be the loss of your investment in the corporation. So by definition under state law, depending of course on what state you incorporate in, you're going to enjoy limited liability for business claims. And I have to preface this discussion by saying you have to set up the entity correctly in order to perfect your sort of limited liability, but you also have to operate the company correctly. Many times entrepreneurs go to an attorney and get the entity set up correctly, but then they sort of ignore the responsibility for accounting for a separate legal person. So you have to maintain separate bank accounts and books and records. When you're a corporation, you have to present yourself as an officer of the corporation, and you don't want to call yourself the owner, because when you call yourself the owner, you're telling people that you're a sole proprietor subject to full liability. So you have to set up a corporation correctly to enjoy those limits to liability, but you also have to operate it correctly. So limits to liability are the big plus for a corporation. And the other big plus for an S corporation is the tax rate. As an S corporation owner that is actually actively engaged in the business, you have to take reasonable compensation, which means you get a paycheck. And on your paycheck, you're going to have state, local, and federal taxes withheld, and you'll have your share of the social insurance taxes withheld also. Your corporation will pay the other half of the social insurance taxes. So you're still kind of paying both pieces of the social insurance taxes, but you can achieve a balance by limiting how much those social insurance taxes are to the amount of reasonable compensation that you take out in the form of a paycheck. The rest of your compensation comes out as a distribution, and that's free of tax because all of the profit after your taxes, after your wages and salaries, go through to your individual tax return, of course getting reported on Schedule E, your individual tax return. So to sort of back up a second, you have to take a paycheck, has to be reasonable, and that payroll that you take out will be subjected to income and social insurance tax. The rest of the income or profit of the company can be taken out as a distribution. And you'll, of course, pay tax on all of the profit after your compensation on your individual income tax return. Now, an S corporation is a little more difficult and expensive to form because you have to follow the laws of your state, and you're going to typically have to file articles of incorporation with the Secretary of State in the state in which you form your corporation. Typically, those laws require that you have bylaws, and bylaws are kind of the operating rules of your corporation. Bylaws talk about the rights and obligations of shareholders in the corporation and who the officers are and what charge the officers have in terms of entering into contracts for the corporation. Because keep in mind that corporation is a separate legal person. And so you have to have an agent to act and be the hands and feet of the corporation. And so the bylaws spell out how those individuals are charged and what the limits of their authority are and the types of roles that they have to play in the corporation. Now, as I mentioned, shareholders of an S corporation receive distributions free of tax, and that, of course, is because the tax has already been paid as a pass-through entity. So that's a little bit more complicated, and that's the S corporation form of doing business. This is one of the most popular forms for starting small businesses because we really like that limited liability for business claims. And we can balance the tax rates and limit sort of the social insurance component a little bit by keeping reasonable compensation at the lower end of reasonable. And so you can save a little money on the social insurance tax using the S corporation in certain circumstances. We can go to the next slide. We'll now sort of move away from pass-throughs into a separately taxable organization. And that's a regular or subchapter C corporation. So it's a corporation, so it's a person legally separate and distinct from the owners. And because of that, and because of state law, you have liabilities that are limited to your investment in the corporation. So if there's a claim in the business, that claim can't go against your personal assets, if you will, and that's what we call limited liability. Now, a regular corporation provides you, depending upon the state law in which you incorporate, with limited liability for business claims. Now, here's the hairy thing, and this is the tax driver in selecting a C Corp. A corporation is going to be taxed twice. The income in a corporation, of course, you know, if you work in the corporation, you have to be paid reasonable compensation. But the income in the corporation is reported and taxed on a separate form, Form 1120. And then, if the owners take out a distribution, we call that a dividend, and the shareholders have to pay tax a second time on the dividend. So there are two levels of taxation for a regular corporation. So the corporation pays tax at corporate tax rates, and then the individuals pay tax when they take out a taxable dividend. So it's kind of an expensive way of doing business, and so we typically see large companies that are publicly traded using this form of business as opposed to small businesses, if you will. Now, the lower end, under $50,000 of taxable income, isn't taxed at a terribly high rate, 35% for federal purposes. The lowest rate, the first $50,000, is only taxed at 15%. And the next $25,000 is generally taxed at 25%. But once you get up over $75,000 and you start messing around with the 34, 35, 38% tax bracket. So having two levels of taxation makes a C corporation a relatively expensive way to do business. Generally, we often see that used for publicly traded companies. Now, that brings us, if you move to the next slide, to the Burger King of entities. We call that the limited liability company. We call it the Burger King of entities really because of the tax driver, driver number two. because you get to select how you're going to be taxed. If it's a one owner, or what we call one member or single member limited liability company, the automatic tax treatment is just like a sole proprietorship. But you still enjoy the limits to liability for business claims very similar to a corporation, because a limited liability company is a separate legal person from the owners. So this is kind of the best of the both worlds. You get the limits to liability, and you get to pick your tax structure. So a single member is going to be taxed as a sole proprietorship unless they choose to be taxed as a corporation. If you do choose to be taxed as a regular corporation, you can also elect to be treated as an S corporation, as a pass-through tax treatment. I'm not sure why you do that, because you just form an S corporation if that's what you wanted to do. If you have more than one owner or member, what we call a multiple member limited liability company, the default tax treatment is just like a partnership. But again, the limited liability company, if it wants to, can choose to be treated as a regular corporation, and once it chooses to be treated as a corporation for tax purposes, it can also elect to be treated as an S corporation. So the limited liability company really is the Burger King of entities, in that you get to be taxed how you want to be taxed. Once you select it, you need to stay in that solution for a while, because there are some limits about changing how you're taxed. Now, the limited liability is a little more difficult and expensive to form, operate, and liquidate. Just like a corporation, you have to treat it, set it up correctly as a separate entity from yourself, and you also have to operate it like a separate entity from yourself. So you have to create what's called articles of formation or articles of organization, depending upon the state. And typically, you also have to have what's called a member operating agreement. And that's similar to a partnership agreement, but it's also similar to the corporate bylaws, in that the member operating agreement spells out who the officers are of the entity and what the limits are for their behavior, what kind of contracts they can enter into, and that type of stuff. Now, the last element for the limited liability company is how our owners are compensated. And members of limited liability companies, I'm going to have to say it depends, because the type of compensation is going to be a function of how you choose to be taxed. So if it's a single member LLC being taxed as a sole proprietorship, the withdrawals from the LLC will be called essentially sole proprietorship draws. If it's treated as a partnership, withdrawals from the entity will be treated as partnership draws. If it's treated as a regular corporation, withdrawals from the company will be treated and taxed as dividends. If it's an S corporation, then withdrawals from the LLC will be treated as shareholder subchapter S distribution. So you have to answer the question for how are owners compensated, as it depends on the tax treatment that you select. So the Burger King is the limited liability company is a very popular form because of the flexibility in taxation and how owners are compensated. And that's why we call it sort of the Burger King of entities. Now, that's kind of the quick discussion of the 4 drivers for each of the major types of Burger King or of entities out there that you can choose to house your business. So looping back to the next slide in our learning objectives, I hope that we were able to talk about and make you sort of understand, if you will, what the 4 main drivers are, and those are limits to liability, how the entity is taxed, how difficult it is to form and liquidate the entity, and last but not least, how are the owners compensated or rewarded for their ownership interest. So we talked about those 4 drivers, as they relate to each of the following entities: the sole proprietorship, the general partnership, a limited partnership, which we often use for real estate ventures, a limited liability partnership, which is an animal of state, depending upon your state, and typically those are restricted to the professions. We also talked about a regular or subchapter C corporation, taxed twice, boo. And we also talked about the subchapter S corporation, which provides you with those wonderful limits to liability, but also lets you be taxed only one time at the individual level. And last but not least, we talked about the four drivers of the limited liability company, or Burger King of entities, if you will, and how those drivers affect the choice for that entity. That concludes our prepared comments with respect to choice of entity for entrepreneurs and starting your business. So the big takeaway is, remember the four drivers in selecting your entity. There are other considerations and lots of details and things of how you can raise capital in the different types of entities and what kinds of benefits and how the benefits are taxed. So there are other considerations. And the other big remember thing here is, remember that the entity is separate from the owner and to treat it the correct way. If you set it up correctly but don't operate it correctly, you'll blow the whole reason for having a separate legal entity. So that's it for our presentation. Are there any questions out there?
Ed, we've got a question from Josh on off the YouTube feed. He's asking, are costs yearly for an LLC?
I'm not sure what costs he's referring to. With any entity, you have a cost associated with setting it up under state law. Often we have to pay an attorney to create the documents that we need and to file those documents, generally with the Secretary of State of the state in which you form your entity. Once you've got it set up, then you're going to have some maintenance costs, if you will. You often will have some costs to do the accounting, maybe some costs incurred to set up and maintain banking accounts and loan accounts, as well as what small businesses often complain about, which are the costs to accept credit cards, debit cards in the businesses. But in terms of the annual costs, there are a few for the specialized entities. For instance, the LLP in some states has an annual registration fee to pay. But other than that, there really aren't too many annual costs, if you will, once you have the LLC or the corporation set up. Are there any other questions out there from our listeners? If not, I'll turn it back over to Jim, and he can wrap it up.
All right, well, thank you very much, Ed, for your time today. I've posted here on the Hangout Ed Jenkins' direct contacts. If anybody's got any further questions for him, his email address and phone number are on there. If anybody would like to contact them, I'm sure Ed, you don't mind that? I don't mind that at all. I'd welcome any calls or email. Okay. I would like to say thank you very much for the chance to chat in VetNet, the Entrepreneur Track. It's been a delight this evening. Well, we thank you very much for your time tonight, Ed, and we hope to, hopefully we'll have you back again sometime. But keep following VetNet Entrepreneur Track here on Google+, and we hope to see a lot of you on Thursday at 5 p.m. for our office hours. Have a good night, everybody, and take care. Good night, all. Thanks again, Ed. Thank you.